In this episode, we're going to be going over the housing market, and we're going to be applying our knowledge of demand and supply to this market. So first of all, what is a house? A house, obviously other than being a building, it's an asset. So it's something that you own, it has a store of value, okay? And therefore it can be seen as an investment for many people, because the thing with a house is the price of a house, it can rise over time, so therefore somebody's wealth can rise over time if they have possession of a house. But obviously, because it's determined by a market, the housing market, the price of houses can also fall as well. So there is a risk involved when buying a house. So we're going to move on to the diagram here. So this is a typical diagram that you might draw if you come across a question and there's something about the housing market in there. Okay, so first of all, notice on this diagram I've done a demand and supply curve, and it has determined what the house price is in this particular market. So let's say it's just for an average 3-bedroom semi-detached house, let's say, for example. So first of all, notice the supply curve. You might notice that it's a very steep supply curve. So we're saying that the price elasticity of supply is inelastic. Okay, so that's one thing that we can say for sure about houses, that suppliers cannot quickly increase their production of houses because it takes a very, very long time to build and plan a house. Okay, so even if the price goes up for houses and the market is like in boom, it doesn't necessarily mean that suppliers, that the construction companies are able to output 10 times as many houses in response. Now the thing is with demand for housing, you could say is elastic, okay? So the reason you could say it's elastic is because the thing is a house takes up a very, very high proportion of somebody's income. So people are quite price sensitive. You may want to buy a house, but you are very limited by the budget that you have. You've gone to the bank, you've asked for a mortgage, and the bank have given you a fixed amount that they're willing to lend, and they can't lend you any more than that. So that's why people tend to be very price sensitive when it comes to housing, just because there's so much money to buy. However, you could also say that the demand for houses in general is inelastic. You could also say it's inelastic because a house has few close substitutes. I mean, if you want to buy a house, the only other substitute really that I can think of off the top of my head is renting a house rather than buying. So you could argue, because there's a limited amount of substitutes, that the demand overall in the market is inelastic, and that's why pretty much everybody ends up buying a house at some point in their life. Okay, what determines the prices in the housing market? As you can see, it's down to demand and supply. In general, housing prices are mainly determined by demand factors and not supply factors, because, as we said earlier, supply tends to take a very long time to respond anyway. So in general, it's stuff like the following, which I'm about to talk about. So first of all, what will determine the price of a house? Well, the amount of jobs available in the locality. So for example, in London, house prices are extremely high, and that's because there's so much work available in London and lots of high paid jobs. So therefore houses in London are a lot more expensive because of that demand. Another thing that might determine the price of a house is the number of schools in the area, or the quality of the schools in the area. If you live near a very high quality school that's got a very good reputation, there'll be a lot of people fighting to live in that area, and house prices will rise as a result. Another thing that will determine the demand for a house would also be the economic cycle. So whether we are in a boom period or a bust period, or recession. Okay, in a boom period, consumer confidence is generally very high. Everybody's confidence is very high. There's lots of people making houses, and there's lots of people doing up their houses, decorating their houses. There's lots of people buying houses. Okay, another thing that might determine the demand for a house, for buying a house, is the alternative cost of renting a house. So if rental prices start going down as a result, then you could argue that the price of houses might start coming down because more people will start to rent in response. Another thing that determines the price of houses is the interest rate. If interest rates are very high, it means that mortgage payments are going to be a lot higher as well, and people's monthly payments will start going up. What this will mean is people are unable to afford to buy houses, and therefore if the interest rates go up, so if the interest rate goes up, then the price of houses will start to come down as a result. Other factors can also determine the price of a house, so like the demographic in the area, crime rates and stuff like that. Okay, so there's probably lots of other factors there, but here are just a few. Okay, so why are we doing this market in particular? Why are we studying it? And the reason is that the housing market is actually very important to the economy. And the reason for that is that, first of all, the housing market, it creates a lot of jobs. So especially in construction, so obviously producing houses, you need builders and construction companies, and also trade as well. So for example, if you are an electrician or plumber and you've been asked to wire a house or put pipes in a house or something like that, so it does create a lot of jobs, and also in decorating as well, and home improvement. Another thing that basically means that the housing market is a very important market to study is that it has a massive impact on consumer confidence, and that is due to this thing here called the wealth effect. So basically, just to summarize this, if your house goes up in price, then your confidence as a consumer and as generally somebody living on this planet is going to go up as well. If, for example, if you bought a house for, let's say you bought a house for 500 grand, okay, and then in 5 years your house doubles in price and now it is worth £1 million. You're now a millionaire. That has made a massive increase over 5 years or so, and that's now doubled your wealth. This causes this thing called the wealth effect, which basically means people's spending habits start to change. People start to, buy more flashy cars, do extensions on the house, go on nicer holidays and stuff like that. It increases spending habits in the economy. So hopefully this video made sense, and now you have a little bit more knowledge about the housing market. Any questions, just please leave them down below.